Sure. Jeremy, thank you for taking time being with us today. Tell us a little bit more regarding your background and your present focus.
I am what I like to call myself a full-time passive cash flow investor. I'm based in Los Angeles. I started investing in cash flow investments in 2002 after I really got sick and tired of the stock market, both because of the volatility and the lack of predictability. This was after the dot-com crash, which is now a while ago in the US. And really, I'm a very low risk, slow and steady guy. And I just didn't like the fact that with the stock market, I didn't know where my retirement account would be in a day, a year, 10 years, 20 years due to the lack of predictability. So I started to look at different ways to invest back then and thought that kind of low risk passive cash flow on like highly stabilized, more predictable cash flow was really the way to go for me. So I've been investing in those types of opportunities for 16 years. And about just over a decade ago, I was able to get out of the corporate world here in the US from the cash flow from those opportunities after rotating all my money out of stocks and bonds into cash flow. So for over a decade now, I've been a full-time passive cash flow investor that I'm constantly looking for new types of opportunities like that.
And when you let's go a little further back, how did you get started? So you work in the corporate world, so it took you a little bit until you actually got the passive income to exceed your expenses. Can you run us through that process a little bit?
Yes, and just to be clear, and it's a little complicated, I didn't just put everything into passive cash flow in a kind of a lower risk way and then I had enough cash flow to leave. I did a combination of kind of mostly commercial real estate investments where I'm a small investor in a bigger deal. It's called a syndication where they pool a lot of investors together. And I really focused on low risk cash flow, like 80 to 100% occupied buildings. So a very predictable, diversified tenant base. That's a part of what I did. The other part of what I did is kind of what I call more medium to higher risk opportunities, but they were calculated risks, where the returns were higher and they were called fully amortized. So let me explain that very quickly. When you invest in a commercial real estate building, an apartment building, say, and you get 10% cash flow a year, when you go to sell the building in the end, you basically get all your money back, hopefully, and maybe a profit from when you sell the building. That's called non-amortized. You have something at the end. Fully amortized is like when you're paying a mortgage down in the US, it's a 30-year mortgage, and you're combining interest and principal into the payment. So the bank is receiving interest of this principal payment every month. And at the end of 30 years, they don't get this payment. It's all paid off, right? So the payments are happening within the payment. So I did more fully amortized, which is called fully amortized opportunities as well, where I got a combination of interest and principal. And what that does is it really supercharges your cash flow because you're not just getting the interest, you're getting the principal at the same time. So I did a combination of amortized and non-amortized investments, and I had a much higher level of cash flow than I could have had if I would have just put it into normal, full non-amortized opportunities. So I didn't have enough capital to leave the corporate world if it was just regular non-amortized opportunities. I did a combination of the two, which was a little bit more dangerous in terms of risk. And eventually, as I reinvested all of it over and over, I got much better balance of amortized and non-amortized. And now I'm mostly fully non-amortized opportunities.
And regarding an investment, because essentially we are always looking for the same thing. We are looking for protection of principal and having a significant interest payment. So you are interested in having a yield that makes sense when you put your money to work. Having said that, I would like to know what's usually your criteria when you are analyzing a deal, because you as me, we do real estate, we all do all sorts of investments. What do you look for when an opportunity comes across the table?
Right. So I would like to say there's 1,000 different ways to invest. So you ask 10 people, there'll probably be 10 different ways they invest. What I do, because I'm very low risk, is I focus on the cash flow. So essentially I have minimum target cash flows that I look for. And to be honest, right now it's 2018 in the US. I think it's a very dangerous time to invest. Prices are very high. That means cash flow is lower. And so, if you get in at the wrong time, at the wrong price, you could potentially have a problem down the road. So I'm very careful with that as well. But basically, I target a minimum of 9% cash flow projected net to investors year one, and a minimum of 11% projected average annualized cash flow net to investors over the course of most of what I invest in is typically a minimum 5-year, mostly 10-year horizon in terms of projected timeline. So those are my cash flow targets. And then when you combine that with, let's say, some assumed mortgage pay down over 10 years and some assumed depreciation, the typical projected returns of what I'm investing in are 15 to 20% per year. But I really focus heavily on the cash flow. I'm not as concerned about the total return because I live off the cash flow. So I'm looking for predictability of cash flow and hitting a certain amount of yield. Like to your point, it's important for me because like everybody else, I have a limited amount of capital to invest. that every time I invest, I'm very picky about hitting those minimums. Otherwise, I'm not going to end up with a portfolio that's yielding what I'm looking for.
But since the markets change, but there are usually some concepts in it, and I mean regarding utilities, there are all sorts of businesses. They're kind of recession proof, as kind of an expression. Having said that, what I like to know is, how do you pick where to invest, just to avoid you spreading yourself too thin?
Yeah, that's a good question. So I'm really highly diversified. So I'll give you an example. Right now, I'm invested in over 70 different opportunities in the US. Now, I do this full time. So you can consider me spread too thin. Some people would think that that's too much, and I understand. I just have to have the full time to be able to do it. And for me, I'm just a huge fan of diversification. So, if average person that I talk to probably considers to try to be like over 20 opportunities, say, 5% per opportunity. And then, of course, you want to diversify out with not just with one operator, but with multiple operators. See, because I'm investing passively, which means that I invest in an opportunity where I have no control. Somebody else is managing the whole thing, and it's usually an expert in that type of asset, whether it's apartments or office or mobile home parks or self-storage or whatever type of asset it is. It's easier for me to be spread really thin because I'm not doing any of the work, right? My work is up front in assessing who I'm making a bet on every time I make an investment. That's the most important part for me, is who I'm making a bet on, more important than what I'm actually investing in each time. So for someone like me, I believe that I don't know if there's such thing as getting spread too thin. If you have the time to diversify. If you don't have the time, then I think that being in at least, say, 15, 20 opportunities, just from my one opinion, is probably a good idea.
Gotcha. And regarding specific sectors of the economy, do you kind of focus on one, or you like technology, you like all sorts of sectors?
Yeah, so I focus almost exclusively in commercial real estate in the US. I do a little bit of residential real estate and some other things associated with it, like short-term loans for flippers, some notes, other thing. But I focus mostly on investing in commercial real estate in the US. And I invest in most of the asset classes in the commercial real estate except for hotels. The only reason why I don't invest in hotels is because the average daily rate changes every day. And so it can also change very quickly during a recession. Because I look for predictability, I try to avoid that asset class, especially during a downturn. And so I do actually make other investments. It's a very small percentage of what I focus on. So we were talking about this before, you and I, but I have investments in ATM machines, for example. I have a few cash flowing websites. I have a few startups, but 99% of what I focus on, which is what I try to really understand well and know as my expertise, is kind of lower risk, passive cash flow, stabilized opportunities, mostly in commercial real estate.
And at this time, don't you find a little bit difficult finding value-add opportunities now, because everything looks a little bit pricey now due to the current market conditions? What do you say?
Opportunities, just because prices are so high that, so you made a point before about investing when there's a recession. So I started investing for a recession in 2013. The reason is because I'm locked in for like 10 years. When I go into investment, they're very liquid in the types of opportunities I invest in. So I anticipated a recession actually around 2018. I've been wrong, obviously, so maybe there'll be one in the next couple of years. But the point is that I have to think very far ahead to avoid the kind of the pitfalls, because I get locked in for a long time. Right now, the only opportunities that make sense to me in terms of where we are with pricing is maybe the right asset class for a recession combined with something at a discount. So I am much more comfortable if there's at least a 10% discount. And part of the reason is because I think there will be an adjustment coming up in the next few years as far as prices. I have to build in some padding by getting some type of discount to market rates. And furthermore, I don't invest really in value add or heavy value add. So I'm not adding some padding by adding value. I'm going mostly into stabilized, which is even more important, that I actually create some type of padding on how I buy it. Otherwise, I might have trouble down the line as far as the valuation.
Gotcha. And regarding these types of opportunities, because since you are investing passively, the operator plays a huge part in this. So trust must be in place. What do you look for when someone presents an opportunity to you?
Yeah, great question. Talk about this all the time. It's you take a lot of steps to try to protect yourself and to really evaluate things as best as possible. But at the end of the day, the most important thing is a gut check. I know it sounds a little intangible, but you ask yourself, adding everything up, how do I really feel about this person? And some of the ways that I like to really try to tell who I'm dealing with is reading between the lines. So a couple of different ways that I do that is I'll create a list of questions for the person. I'll do a phone call once I read the opportunity. And then sometimes it's not even the content of what the answer was and whether that was correct. It's almost how they phrase it. So I'll give you an example. Let's say I ask a question about why expenses are increasing at a certain rate, okay, whether it's too low or too high, in my opinion. If they say, look, we forecast that expenses would increase at 3% per year to be conservative, even though we think they're going to increase 2% per year just to be conservative for investors. That's the kind of answer that I want, because I want to make a bet on someone who's conservative, who's under-promising, looking to over-deliver, to build long-term relationships and repeat relationships with their current investors. The other way around is no good, and I see it sometimes where somebody's making the numbers look better than they might be to make them to be aggressive. They don't really care if they necessarily keep a long-term relationship. They just want to get the deal done. And that's the kind of thing I'm trying to avoid. So I'm looking for someone who's conservative and listening to how they answer to try and get a sense of that. The other way I read between the lines is looking at how the actual opportunity is written with regards to that. Sometimes they'll have those types of phrasing in there. And if you read between the lines of even how it's written, sometimes you could tell a little bit who you're dealing with. I also always do background checks on the managers of the opportunity, very extensive ones. And that is very, very important. It's definitely saved me a number of times over the past 16 years. And even just, so give you another example, even just the question of like when I go to do background check on somebody, ask them for their name, date of birth, and home address. If they're not comfortable giving me their date of birth or home address, or if they don't want me to run a background check on them, you have to wonder what's going on. And then I even say to them, look, before I run my background check, I'm going to give you one chance now to just let me know, is there anything I need to know before I run this background check? And sometimes what happens is they won't tell me, say something came up, maybe it was from 20 years ago, and they're kind of thinking, oh, it's not going to come up, it was from 20 years ago, but it does. So, you kind of just got to take advantage of the opportunity to read between the lines and give them a chance to kind of give you a real feel for who they are. It's not very easy. I've gotten used to it. And also another rule is that I will never invest with someone unless I've actually met them in person. And that's just to do the one-on-one in person. I mean, we're on electronic Skype and everything, and that probably would be okay. But I feel like in person is always an important check as well.
Yeah, because as we were talking about this earlier, something happens when you actually look in someone's eye. You know in a second if it makes sense or not. And
right.
Even they might have like a full text already memorized, but you kind of you read the body language, you understand the person. Something you have this gut feeling. I think as we get older, we this improves, at least from my end of it.
I agree.
Yeah. Having said that, I also like to focus regarding the acquisition of companies. Is this something that interests you regarding full private equity? What are your thoughts on this part?
That's something I'm just not at all an expert in. So the way that I look at it is that when you invest in companies, you're investing in a cash flowing opportunity, but you're really investing in the cash flow. Very often, there's not that much in the way of assets. There might be patents, there might be some inventory, but you're mostly you're investing in the current cash flow and in the actual people to create that cash flow going forward in terms of sales. What I like to invest in, and just because I'm more an expert in over the years in terms of all my experience, is asset-based investing as opposed to cash flow-based investing. To me, I like the idea of investing in a hard asset so that even if the operator or the person you make a bet on has a challenge, if you replace them, you could potentially get the asset back into good standing. You've got an asset that typically can be valued by a third party, whether it's an appraiser or somebody else. And frankly, in a lot of these markets, it could be easier to sell, let's say, a building or a house than it might be a business, because it might be easier to value, because of comparables and everything. So for many reasons, I don't really focus on businesses. Probably there's a lot of good deals on businesses. Frankly, it's just not my field of expertise. I just don't know it well.
And also regarding the developments, is this something that interested you? So like here in Portugal, we have to explain to you in order for you to understand where I'm coming from. In the US, you'll get taxed to death when you fix and flip a property. So you usually hear about those 40% gains, but in reality, it's more like in the 10% because you get capped from taxes. But in Portugal, that doesn't happen. Taxes are really low. So basically, they are kind of helping you in order to fix and flip properties here.
Yeah, they're encouraging it. That's what they want you to do.
Yeah, and usually have the pricier one. So kind of New York thing, but here in. And what I like to know is, would this be something that interests you, or you kind of fix and flips is just not your thing?
So I've invested in fix and flips in the past in a fund where it was more diversified pool, but that was at the right timing. So That being said, in general, I don't invest in developments or major value add. And the reason is because I invest typically for cash flow. So I look for that predictability of cash flow. The developments intrigue me. And I always said to myself, look, I want to build a really, really solid basic cash flow. I want to get the 3 times cost of living, which I'm not at yet, but hopefully will be in the next few years. And then I'll look at maybe developments at that point, because developments are harder to predict. They're higher return for higher risk. And I usually focus on low risk, but I like the idea of maybe diversifying into a bit of a higher return, with the understanding that I have to be able to absorb the fact that if it doesn't perform as expected, it's okay. I'm not quite there yet. And it's because I'm very low risk. Like if you ask people that know me, I'm very low risk. So it's hard. It doesn't really mesh with my personality either. But eventually I'm sure I will. I've never invested in development, but hopefully I will eventually.
Because I'm mentioning this because lately I've been looking at a lot of development deals, and one thing that's like a common thread that kind of always crosses my mind when I'm kind of in meetings with operators is that how if will the thing plays out if the guy actually doesn't sell it, and it's something that kind of you get this feeling in the back of your spine. Do you understand what I mean?
Yeah, and that's the backup plan, right? So let's say you're fixing and flipping a house, but you can't sell the house. Let's say there's a downturn, something happens. You have to have a backup plan, for example, to be able to rent it. And you have to know going in that once the house is fixed, per your budget, what rents am I going to get? What cash flow am I going to get? So you have to pencil out and make sure that your backup plan works. And I totally understand your concern. But that's why I'm saying that you should be getting a higher return for that flip in exchange for the higher risk, because those types of things can happen. And I want to point out too that, it's a dangerous time in the cycle right now to consider that, because if we have a downturn, that's when you can get stuck having to hold the house and rent it. And I'm just going to, in the US cycle, we had our downturn in 2008, 2009. So if you went to fix and flip a house in 2011, the odds that you would be stuck with it, very low. Right now, the odds are not low, because we may end up back in another downturn right now. So you have to take that into account too. And what really scares me about doing a flip right now is that the returns are lower than they used to be. That happens at the end of the cycle when there's most money chasing the deals, yet the risk is the highest, in my opinion, because you could have a downturn and the returns are low. So I always change what I'm investing in as the cycle goes on. I continue to shift. When something gets crowded and the returns go down, I go on to the next asset class. And that's one really great thing about the flexibility you have when you're investing passively. You can pick and choose where money is going to go next, because you're making it about other people versus having to buy it yourself and become an expert in one asset class.
There's one time just in front of here in Portugal, in Lisbon, like in Wall Street, we have Euronext. It's essentially the same type of street, and right in front of it was Portugal's wealthiest person. And I actually went by and actually presented myself and started speaking. And the one thing that he told me that I keep this in the back of my mind every time that I hear an operator promising returns and telling about all kind of wishful thinking, I keep going back to what he said. You know what he said? He said, in business, we always look for this revenue just like this, always solid, always in line. We don't like something like this. And the other thing is, it must always be sustainable. Doesn't matter if you have like $1 to your name or you have like 1 trillion. It's always the same thing. Be sustainable. You never go full in, and always look for this. And when you hear those words, and every time that you are faced with someone that you know he's not a billionaire, it doesn't have the same track record. When I hear something like suggesting spikes, it usually scares the crap out of me, to be honest, because the probability of something going wrong. So I think it's best to kind of eliminate what potential be a unicorn and kind of go play safer. What do you think?
I agree with you. That being said, it's funny. I've invested in, I think, 3 startups in the last 5 years, maybe. And that's not very much. And for me, because I'm a full-time investor,
sure.
Every time I invested in a startup, there were 2 ingredients. One is I had to make a bet on this person I knew who has been successful in the past, and just that type of person you want running the show. I just had to make the bet. I didn't want to not take. Okay, and it was always in the seed round. And the reason why I was in the seed round is because if I'm going to put up a little bit of money and take that level of risk, I want the maximum possible return, to your point. So if you're going to have the risk and the volatility, at least put yourself in a position to maximize the return. That's the way that I do it. So I won't invest on a later stage in a company, not even like in the kind of mid stage or early to mid stage. I want to put the first money in, make a bet on the right person and see what happens, so that if I'm going to get compensated, at least it's going to be like, the grand slam. That's the way that I look at it. Besides that scenario, which is very rare for me, I invest the exact opposite way, to your point. And I just, I tell people I want to go to sleep tonight, wake up tomorrow, and not much has changed. That's really what I count on, because I count on the cash flow coming in. It's the same idea of just going flat. So I 100% agree.
Yeah, me too. This is what I think it makes you look in a different way. It's like that speech Jeff Bezos gave. If you look for something like in 50 years time, it kind of shifts your perspective, because if you're looking like short term, it's a different mindset. When you're looking things like long term, like, will I be still doing this for the next 50 or 60 years? You look at things from a different perspective.
Yeah, and I want to say that the number one thing that when I have these types of conversations, the number one thing that always comes up, and I just had this yesterday with somebody, and I could tell they just want to make the big return quickly. And that's where you can get into trouble, right? Because that's where you get the spikes. I've been investing 16 years, and I'm already thinking like 10, 20 years ahead. And when I started, I was thinking 10, 20 years ahead. I think the challenge is that a lot of people don't have the patience to think 10, 20 years ahead, because they want to be done with it tomorrow, and they want to be rich tomorrow. They want to get their returns tomorrow. And to me, the number one thing you could do to help yourself is to have the long-term perspective, because that time allows you to fix certain mistakes over time. And most importantly, allows for compounding, which is a huge effect, right? And I have the fortune of now having been focused on this for 16 years, so I'm in a much better place than I was 16 years ago. And frankly, I'm looking forward to 10, 20 years from now, because I know I'm going to be in a better place. But I'm giving myself another 10, 20 years to look forward to, because it takes a while for everything to snowball to build. So it's a really slow growing snowball. And if you treat it like that, you can do really well. But if you want the snowball to all of a sudden just be huge, that's, I think, where you can run into problems.
I agree. Regarding mistakes and advice, going back, advice to your younger self, what would you say?
Number one piece of advice is start investing as early as possible. I started this type of investing when I was 28, and relatively speaking, it's not a bad age. But if I would have had an extra 10 years, I'd be what I was just telling you now, I would be 10 years further ahead in a even better place, right? The cash flow has truly changed my life. And if I would have understood that earlier, I would have started that cash flow plan earlier, because it got me out of the corporate world. It's given me the freedom to do what I want. My son, I think it was in 2011, my son had a very bad virus, was in the hospital in the ICU and he was only 1 year old, for a few weeks, was in the hospital for a few months, had multiple surgeries. My wife and I were in the hospital, one of us, 24 hours a day for months. Okay. There was no way I could have done that without the cash flow in the corporate world, without having major problems with either vacation pay, sick pay, having trouble keeping my job. Cash flow has just changed my life immensely and given me kind of the power back to make decisions of stuff that I want to do. So if I would have understood, I would have hopefully understood that when I was younger, and would have been able to explain it to my younger self earlier to really get focused on it.
And regarding this, because to your point, I think this is important. People that are starting out, and they may have read all the books, all the Kiyosakis, all the full 9 yards, but they still don't have the track record, they still don't have the experience. Having said that, what would be your advice for someone starting out, maybe listening to this podcast, something that they could start in order for them to kind of shift toward what they actually have to be in a couple of 10 years ago?
Sure. A couple of things. First of all, I think it is important to read some of those books. Frankly, I didn't do that myself. I should have, but I love two books I always recommend, just as an aside: Rich Dad, Poor Dad from Robert Kiyosaki, and then Cash Flow Quadrant from Robert Kiyosaki, in that order. Really two good books back to back could change your mindset completely. So that's number one. Number two is having the long-term mindset is so important. I've talked to a lot of people who are working in the corporate world who have a plan, maybe a 5-year plan, an 8-year plan, some of them a 10-year plan, how to get out. Frankly, a very high probability of getting out when somebody has a 5 or 10-year plan, because you're giving yourself enough time to be realistic, to really get out, to learn properly, and to do it. And I love watching people get out of the corporate world, because I know what kind of difference it makes on your life. I've been through it. So number one is have a realistic expectation of your timeline, have a reasonable plan on how to get out. And then as far as how to create the plan, As a pure investor, what I find is that people usually like to be either active or passive. And what I mean by active, I'm just going to talk about real estate for a second because of what I understand. Active is when somebody has control. So if they even owning a single family home, even though you're not managing it, you may hire a third-party manager. You have the ability to hire and fire the manager anytime you want. Sell the property, finance the property, refinance the property, sell the property, whatever you want to do. You get to choose which toilet has to be changed, what repair has to be made, and what price you're going to pay for that. That to me is active. Passive is someone who gives up control for diversification. That's what I do. So basically, when I'm passive, I'm making a bet on some other person. I increase my risk because I have fraud risk, mismanagement risk, and other things. When you're making a bet on another person, we talked about that trust. There's risk associated with that. And the way you kind of help yourself through that risk is you diversify. So you diversify across operators, diversify across geographies, you diversify across asset classes. That's why I'm so diversified to 70 opportunities. It's because I try to diversify out of that risk, even though you can't ever get rid of that risk, right? So my point in telling you all this is that I chose passive as a path for myself because it made the most sense for me and my personality. And when I started in 2002, I was very busy in the corporate world of my job and I couldn't do it actively. But not everybody has the personality for active and not everybody has the personality for passive. I think the most important first step is to try to figure out, are you better suited for active? Do you want control? Or are you better suited for passive? Do you have no time to sort it out and maybe are willing and comfortable making a bet on somebody else? You got to figure out which path makes sense first, because in real estate, you're very illiquid investments. You can't just press a button on a screen and get your cash in 2 days from selling a stock. So if you go down the active path for a couple of deals, a few deals, and then say, you know what, this isn't for me, it's not right, you're a little bit stuck because you haven't diversified enough. It's not so easy to sell your assets, and it might be the wrong time to sell your assets. And then you want to come right back down and go down the other path. It's hard to unwind, So if you go down the passive path, invest in 5 opportunities, and then you say, you know what, I need to have control. This isn't for me. It's a problem. In the US, you can't sell your shares for the first year. It's illegal, according to the SEC, to sell your shares in a company that you invest in for passive investing for the first year. After that, very hard, very illiquid market on the secondary market, hard to value what the shares are worth. Sometimes you have to take a discount. So if you want to rewind from that, it's hard to. And then if you're stuck owning 2, 3, 5 opportunities, you haven't diversified out of the risk of the fraud risk, the mismanagement, and then you're stuck. So it's very important to take the time to learn, think about which is a better path for you first. Once you figure out the active or passive, then you could maybe take some time to get educated on the options of those paths and then choose the correct ones for you. But I always tell people the best thing you could do is figure out the active versus passive piece first as best as possible, and then try to go down that path. But take the time to figure that out first.
Gotcha. And regarding for the future, where do you see yourself and your company heading forward?
It's funny, just like we talked about, I just see myself doing the same thing. I happen to love what I do. I happen to love investing. I'm very lucky. And I love the fact that I'm just spending all my time maximizing my own cash flow, my family's future, net worth and situation. And so I really have no reason to not continue doing what I'm doing. And frankly, to be honest, if I continue doing it, I get the snowball to become bigger. And I'm doing myself a big service because I'm giving myself more and more of that time to actually have a much bigger and bigger situation down the line. More and more cash flow, hopefully more net worth. So I am absolutely going to just continue focusing on the same thing as far as I'm concerned.
And finally, where can our listeners get a hold of you if they have any further questions?
Sure. Yeah, I don't have a website. That's just because I like to keep, I kind of like fly low under the radar. And there's other reasons because public solicitation, investors, all kinds of issues in the US. So the best way to reach me is my email. So it's jroll, JROLL, at Roll Investments, which is ROLL investments with an S.com. So jroll at rollinvestments.com. Definitely the best way to reach me. Thanks.
Jeremy, it was wonderful having you with us today. I will speak with you soon.
Great. Thanks for having me. Really appreciate it.